Good morning, everybody, and welcome to Headline Money's Tax and Estate Planning Masterclass in association with Canada Life. We're pleased to have with us today Neil Jones, Tax and Estate Planning Specialist at Canada Life. And Neil will be giving us an overview of personal tax and estate planning. And before we properly get into the webinar, I'll just outline how things are going to run today. So the session will last for around an hour. Bearing in mind that we started late, we will try and keep things moving today. First, we'll hear from Neil, and then we'll open up the floor to questions from you. So there are quite a few journalists on the call today, and so you've all been automatically muted and your video is turned off. But we do really want questions from you. So we're asking you to use the Q&A box at the bottom of your screen. So if you do have a question, please use that. Just type it in there and Neil will answer your questions in the Q&A time at the end. And finally, if you'd like to tweet during the masterclass, our hashtag is #HMMasterclass. Right, so now over to Neil.
Yes, thank you. Thank you, Claire. Yeah, good morning, everybody. So what we'll do is I've got some slides that we'll run through and we'll look at estate planning and give you sort of a high level understanding of some of the issues and how things work. And hopefully we'll try and, as Claire said, we'll try and speed things up so that we can try and keep within a time frame, but we may go a little bit over 11 depending on questions and that sort of thing. But right, okay, if I can share my slides. Hope everybody can see that, can they? Yeah, excellent. That's good. Right, okay. So what we'll do is we'll go through, make everything look a bit neater on my screen. There we go. Right. So what we'll do is we'll go through the slides. We'll cover off some aims. Obviously, the reason why people do estate planning, a lot of it is down to tax, but we'll have a quick look at that. I don't know if you joined me on the masterclass before Christmas, I think it was, where we did personal tax. We touched on inheritance tax a little bit there, but we'll go into a little bit more detail. I'll try to keep it as light as possible, but obviously there's some things that sort of help explain some of the strategies that people will use when you go on. So we'll look at those reliefs and exemptions, the ability for people to gift money, which is very important for estate planning, and how that works with regards to trusts and business relief schemes and life assurance. Some of the solutions. There is one of the solutions which I haven't mentioned in these slides, which is for extremely wealthy people. So this is more for retail. Your sort of man in the street type person, rather than the extremely wealthy who would use things like separate companies and whatever. But we can talk about that at the end if need be. Okay, so why does anybody actually need to do any estate planning? Well, there are two main reasons. First is tax. They want to reduce the amount of tax that they pay when they die, or the amount of tax on their estate, and that effectively maximizes the benefits that they pass on to their beneficiaries, such as children, grandchildren, other wide parts of the family, or even friends. So generally people want to maximize the amount of money they leave, and they do that by paying less tax. And the second reason is control. It's very important to make sure that when you pass money to your beneficiaries, whether you do it during your lifetime or on death, that you do so in a way that's controlled, just to make sure that that money is used in the way it was intended. It's very easy to give money to people. I've got a son who's coming up to the age of 18. I'd imagine if he received a large sum of money, he'd go and spend it in such a way that probably wasn't intended by the person giving him the money. So sometimes control is very important, and sometimes it's more important than the tax side of things. So there's different solutions that can be used and different ways people go about it. Now, essentially, the four steps that I'll go through, people wills and power of attorneys are very important to set up. They're very cost effective. They don't cost a lot of money, depending on how complicated you want to make it. But it's surprising the amount of people that don't have a will or don't have a power of attorney in place. So we'll cover that. We'll cover off the exemptions. And then when we start talking about strategies and what people will do, there's two terms there which many people probably wouldn't recognize, and that's chargeable lifetime transfers and potentially exempt transfers. And I'll explain the difference. I didn't want to try and get into too much lingo, but it's almost necessary to try and explain the strategies that people use when they try and pass on their estates. So if we start with wills and powers of attorney, as I say, very straightforward to set up, can be as simple or as complicated as people want. Now, if somebody dies without a will, effectively there's a steps and there's a flow chart that goes through depending on where people are based, whether they're based in England and Wales, Scotland and Northern Ireland. Each have their own different legislation. But if somebody dies without a will, basically that the state and the legislation determines where the estate is distributed to and where it goes to. That invariably is not usually where people want it to go to, so therefore people write a will, and a will is effectively a bit of paper that you give to your executors, and it says, this is how I want my estate distributed, and the executors are the people who will make sure that the estate is distributed in accordance with how you want to. Now, as I say, it can be as simple or as complicated as you want. You can leave specific legacies to specific people, and that tends to avoid sort of family disputes. If you've got somebody who's got a classic car in the garage and a couple of kids who are fighting over who wants it, if it's in the will as to who gets it, then it stops the arguments. So it can be very good from that point of view. You can use it to create trust, which is part of a strategy, which we'll come on to, which obviously can alleviate some of the inheritance tax that's paid or payable. Very important if you've got kids, because you want to make sure that you've got guardians in place and who's going to look after the children later until they reach the age of 18. You've got things called codicils and deeds of variation, which you've probably heard about. Codicils are basically add-ons to the will, so where you want to change a bit. So instead of having the whole thing written again, you just add a little bit onto it. And a deed of variation is a very good tax planning tool, because it allows somebody to vary a will within 2 years of the date of death. So somebody dies, leaves a will, passes the estate out to their beneficiaries. If their beneficiaries want to change it, they've got 2 years from the date of death in which they can change it. And that was in the press a few years ago. I think there was a few politicians that use strategies like that. But it's perfectly legal, perfectly above board, and people do it, and it does change the tax position. It can make it more beneficial. And then we've got powers of attorney, again, something which people tend to overlook. And a power of attorney is a very powerful document, because if you lose mental capacity later in life, so especially with elderly clients, what they can do is they can appoint an attorney. So if they're not able to look after their own financial affairs, they are, generally would have either solicitors or other family members who would then be able to take over their family financial affairs, or their or any sort of health issues. They can put people in place who can make the decisions for them, and that's the legal document that allows that to be done. And you can complete those legal documents at any time. You can go onto the Court of Protection just to make sure that you can go onto their website and just download the forms and have that done. You have to register them, and then if you register them and then lose capacity, then your attorneys can actually then activate that power of attorney and make sure everything can be catered for. So covers sort of emergencies, and especially, as I say, later in life when people have health issues. So very important to do, and very, in the grand scheme of things, inexpensive. So one of the things to bear in mind with wills is the issues about what happens when people get married and divorce. Now, when people get married, their will is invalidated. So if somebody has a will, or a man and a woman have a will and they get married, then their will is invalidated. It basically doesn't mean anything anymore. So they have to write new wills. Same with civil partners, so same-sex marriages and that sort of thing. It's very important to make sure that if somebody gets married, they review their will and they put a new will in place. Obviously, their desires in their will probably will change when they get married, but it's important to make sure that that's done. Even if people have been cohabiting for a number of years, if they then get married, they need to redo their will, even if it doesn't actually change anything. Now, one of the differences is when people get divorced, it doesn't change. The will effectively stays in place. It doesn't get voided or invalidated. There is a few sort of slight changes. So again, if somebody gets divorced, very important to review it. Usually there's a solicitor involved somewhere along the lines with the divorce, so you'd hope the solicitor would point it out. But effectively, from a will point of view, the ex-spouse is deemed to have died on the date of the dissolution of the marriage or the civil partnership, but they can still claim if there's any sort of hint of financial dependency. So you could have people sort of claiming under a will where the deceased quite clearly didn't want them to actually benefit from it, but they could. So important to make sure that that's reviewed, to make sure the money doesn't go to anywhere where people don't want to go. Now, we did some research recently, where we looked at the number of online divorces that were requested through the HM Courts and Tribunals Service. And as you can see, there was a significant increase from 2019 to 2020. Now, you could probably blame lockdown for some of this, obviously people being in close quarters for a long period of time, but there was a significant increase. You can see it's up 53%. Which was a lot, obviously. And interestingly enough, there were actually applications for divorce submitted on Christmas Day and New Year's Day. Christmas Day does make you wonder if it was somebody wanted a Christmas present, so they decided to do it there and then. I don't know. But you can see that divorce is on the rise, and a lot of people, if they haven't spoken to a solicitor or done things properly, could miss the fact that their wills need to be updated. So very, very important that people do that. And as I say, not expensive and very simple to do, but surprising the amount of people that don't do it. So just straightforward. So people should just be doing that. Now, obviously, one of the things I mentioned earlier was tax and how people want to reduce the amount of tax that's payable when they die. And they do that in order to maximize the benefits that go to their family or their legacies that they leave. Now, I'll touch a little bit more on inheritance tax. We'll go into it a bit deeper than what we did last time. But effectively, everybody gets what's called a nil rate band, which is £325,000, which is frozen up until April 2026 and has been frozen since April 2009. So you can imagine, with house prices increasing and values of investments increasing and people saving money, estates are more and more likely to be caught by this nil rate band. So the nil rate band is basically your first £325,000 of what you own is taxed at 0%. It is subject to inheritance tax, but it's just at 0%. Anything above that is going to be taxed potentially at 40% or 36%, which we'll come on to. Now, in addition to the nil rate band that everybody gets, there is also a residence nil rate band, and this was introduced by George Osborne and David Cameron because they had an election promise in their manifesto where they said that they would let everybody be able to pass on £500,000 and married couples could pass on £1 million, and they did it by using the residence nil rate band. And we'll have a closer look at the complications that caused by just not doing it properly, to be honest with you. Now, inheritance tax, obviously receipts have continued to increase, especially, have continued for year on year to increase, to be honest with you. And we've seen sort of slight increases over the last 12, 18 months, maybe due to COVID, anecdotally, or other matters. But generally, it's around 5.3, 5.2 billion a year, or it has been for the last couple of years. And so that's quite a lot of money for the Treasury. To put it into perspective, the total tax take in 2020-21 by HMRC was 584 billion. So you're looking at around about 1%. So although 5 billion is a lot of money, in the grand scheme of things, it isn't. And we've done a little bit of analysis there. It costs roughly about £70,000 to train a nurse. So if you think the inheritance tax could fund 75,000 nurses, so you can see that if there's a small increase in inheritance tax, they could fund other things with it. Obviously, 1 week's worth of pension benefits and welfare benefits as well. So it just sort of puts it into perspective. People think it's a big number, and it is, but in the grand scheme of things for the government, it may not be as important as some people think it is. And it's already charged at 40%, which makes it very high. So it's questionable as to whether they could actually increase their rate anymore. We have had higher rates of estate duty and capital taxes in previous governments. If you go back to the 70s, it was well above 40%, but certainly for the time being, it's a very emotive tax and a very disliked tax. So I don't think it will be an election winner if people increase it. If we have a look at trends and how things have moved, we've got there the nil rate bands is in the blue and the orange. So as you can see, we've had the standard nil rate band has been around for a number of years. It does go back to 1986. And we had the residence nil rate band that was introduced, as I say, when David Cameron and George Osborne were in the government to meet an election promise. And as you can see, I've put on there the receipts that have been received year on year, and also using that sort of similar growth rate, then just carried the line on up until 2030, 2031. So you can see that it is forecast to carry on increasing. Obviously, the government have their own forecasts in the budget, which are fairly similar to this and where a lot of the figures have come from. So it is a tax that's going to carry on rising. And as I say, it's an extremely unpopular tax. But there are things that you can do about it. And one of my favorite, well, come on to one of my favorite quotes in a moment, that around inheritance tax, but it's not paid by everybody. So what I've put together here is figures to show the number of estates when people die that are below the nil rate band, so below 325,000 and therefore charged at zero, and those above where potentially there is tax payable. Now, as you can see, the last figures we have are from 2017-18, and there were nearly 75,000 estates that were above the nil rate band. But only 24,000 of them actually paid any inheritance tax. The rest were covered by exemptions and things like that, that allowed them not to pay inheritance tax just by using the exemptions and the allowances that are available to them. So it doesn't catch an awful, it catches, as you can see, around about sort of 15 or 13% of the estates. So it's not paid by everybody. So although people do plan, a lot of the exemptions that exist do allow people to reduce the amount of inheritance tax payable. And this was a quote that was, it was attributed to Roy Jenkins, who was the Chancellor of the Exchequer. And I think it was made in 1986, which strangely enough was when inheritance tax was introduced, which is why I love this, because you've got Chancellor of the Exchequer who introduced a new tax and basically called it a voluntary levy, because there's, and he said that because there's so much that you can do, that people can do to reduce the inheritance tax payable. So it's a very powerful statement, used in numerous different guises and presentations and news articles, because it's a very significant statement to have made. So if we have a quick look at what people pay inheritance tax on and what they don't, well, inheritance tax is generally a tax on capital transfers. So if somebody has a lump sum of capital and it changes hands, potentially you've got inheritance tax to pay, and that can be when somebody dies. So anything that they own when they die, their house, their savings, their investments, their car, that sort of thing, if they've got a Picasso hanging on the wall, everything that they have is then valued. There's things called that they would have, or they could have, beneficial ownership to. So they don't own the legal title to it, but they benefit from it. And if they benefit from it, then that's deemed to be in their estate. And that's really some types of trusts that exist. There's also things called gifts with reservation, which you tend not to come across very often. It's where planning has failed because they haven't done things properly. But if you think somebody may give their house away, but continue to live in it. If they give their house away, they don't own the legal title, but they continue to live in it. Therefore, they're classed as what's technically called a gift with a reservation. They've given it away, but they've reserved the right to live in it, really. And in that instance, the value of the house stays in their estate. It doesn't work for inheritance tax. So HMRC will still tax it. Now, the other thing to bear in mind is that they look at what we call potentially exempt transfers and chargeable lifetime transfers, which are when people gift capital when they're alive. So lifetime gifts, generally, if you give money outright to somebody, so if I was to give money to my brother, say, just buy him a check or give him a wedge of cash, that would be what we call potentially exempt. If I put it into a certain type of trust, it would be chargeable to inheritance tax at the time I make it. So slightly different, and it does give different outcomes for people, but it allows this. When we start talking about trust is when you come onto the control bit. Now, the logic behind inheritance tax works in a 7-year cycle. I don't know why it's 7 years. It just always has been. I have tried to find out, but it's very difficult. And basically, if you make a gift, once you've survived 7 years, it falls outside your inheritance tax calculation. But if you die within 7 years, it's included. Now, what you don't pay tax on, there are exemptions, as I mentioned earlier, that people utilize. Now, if you leave anything to your spouse or civil partner, that doesn't attract inheritance tax. There was a very famous case, I think it was Ken Dodd, when he was very late in life before his death, he married his long-term partner, and that allowed him to pass his wealth, his millions that he made during his life, to his partner, and that avoided inheritance tax. And it was reported in the press that he'd done that, for inheritance tax purposes, which is great. But obviously, he's then put money into her estate, and then when she dies, she's going to pay inheritance tax on it. So although it sort of got rid of the inheritance tax when he died, it just really deferred it. because he's passed it to her. Now, obviously, if she remarried, she would have another spouse, could leave money to that person, and that would be exempt as well. So people can get remarried, but if they don't, you're just, as I say, just deferring the inheritance tax that's going to be paid on it. So so exempt transfers anything to spouse or civil partner. If your partner is a non-domiciled, then there are different restrictions, and it's capped. So it's actually capped, strangely enough, at 325,000 as well. Bit of an unusual circumstance, but it's still there. Anybody can also give away £3,000 a year. Don't pay inheritance tax on that. So your first £3,000 is fine, and if you don't use the previous years, you can carry it forward. So you can have up to £6,000 that people can make, and there's also small gifts that people can make on marriage. Now that £3,000, the marriage gifts of anything up to 5,000, and there's a small gift allowance of £250. They were introduced in 1986, and they haven't changed. They're not indexed; they're just fixed. So in 1986, they were a bit more significant than they are now. If you look at somebody who's got £500,000 estate, £300,000 isn't a great deal of money, but it can come in useful with some of the planning solutions. Surprisingly, gifts to charities are exempt, and also gifts to political parties, which is quite interesting. So there's no inheritance tax on those. And also, because inheritance tax is a tax on capital transfers, if anybody has genuine surplus income, I have 2 kids, so the concept doesn't really exist for me, but if you have genuine surplus income, you can gift that income, providing it's regular and it doesn't affect your standard of living. So you have to do an income and expenditure analysis for HMRC. But if you can demonstrate that, you can actually give away your surplus income, and it doesn't attract inheritance tax. And then finally, there are 2 reliefs that are available. You have business relief and agricultural relief, and I've got a slide on those a bit later on, so we'll cover those in a bit more detail. So who actually pays inheritance tax? Well, the individuals, if I die, my estate will pay inheritance tax if it's above £325,000. If you're UK domiciled, so you consider the UK to be your home, you will pay inheritance tax on everything you own in the world. Wherever it is, you will pay tax based on your domicile. If you're non-UK domicile, then you will only pay UK inheritance tax on things that you own in the UK. From a planning point of view, if you're non-UK domicile and you have a bank account, you wouldn't generally have it in the UK just in case you died, because then it's going to be subject to inheritance tax, so you tend to keep it offshore. Obviously, you get a lot of world shrinking, so you get a lot of people moving to the UK and they will buy houses, so their houses will be subject to inheritance tax. But if it's a movable asset, then they were just taken outside of the UK. And domicile can be something that is probably a whole separate conversation, but there have been some instances where people have claimed to be non-UK domicile, but HMRC have argued that point and said you are actually domiciled in the UK. Very famous Richard Burton was one who claimed to be non-domiciled. I think he lived in Switzerland, from memory, but because he wanted his ashes spread across a particular valley in Wales, HMRC said that you still considered England and Wales to be your home, so therefore we're going to treat you as being domiciled. So people can fall foul of that. Other people who pay it, if anybody receives any potentially exempt transfers and somebody dies within 7 years, there can be tax on that, which we'll come on to. And also there's trustees. So if you set up a particular type of trust, usually discretionary trusts, they, as recipients of a transfer, could have inheritance tax to pay if somebody dies within 7 years, and they also have taxes to pay, potentially on money going in and money that's in the trust and money that comes out of the trust. So there can be a whole raft of trust tax available for that. So what rate is paid? Well, as I say, it's 0% on the first 325. That's why it's called a nil rate band. It's not called allowance. It's not an exemption. It's not a relief. It's just a band that is taxed at 0%. And as I said, it's frozen. You've got £175,000 for the residence nil rate band, and that met the election promise that David Cameron and George Osborne made, where they said they wanted everybody to have $500,000. Well, they did it. Instead of increasing the nil rate band to $500,000, which would have been the simple solution, they introduced the complexity of having a different nil rate band, which is only available to certain people. So not everybody can make use of it. If somebody makes chargeable lifetime transfers over their nil rate band, then they pay 20% tax whilst they're alive at the time they make that gift, or the trustees do, sorry, the recipients do. And also, generally, the standard rate of inheritance tax on death is 40%. But if somebody leaves a legacy to a charity and leaves 10% of their net estate to charity, then that rate falls to 36%. So it encourages people of a philanthropic nature just to make charitable donations in legacies in their will. Now, it is possible to use the nil rate band from a spouse. So, for example, if my wife died and left everything to me, she doesn't use her nil rate band because everything comes to me and it's exempt. So then when I die, I'll get 2 lots of 325,000 and potentially 2 lots of 175,000, because that then gives me $1 million to pass on. So anything that is not used by a spouse on the second death can be used and is claimed by the executors. So what happens when people value an estate? Well, when people have made gifts, you have to take into account the gifts that they make. So we've got a client here, or an individual here, sorry, who's made a gift. Doesn't really matter how much it is at this stage, and 2 years later makes another gift. And then 6 years down the line, sadly, they die and they have their estate that they've left on death. So their houses, bank accounts, investments, cars, and so on. Now, what happens is, to value the estate that they leave, you actually need to go back 7 years before the date of death and look at what gifts they've made, and any gifts that aren't exempt. Obviously, if they've made that gift to a spouse, or it's only been £3,000 a year, then they're okay, that's exempt, it doesn't come into the equation. But if they made sizable gifts, well, the first one they've made, which was 8 years ago, well, that's more than 7 years, so that's gone. That's not included in the calculation. However, the gift that they made 6 years ago is. So what the executors will do when they value the estate is they will take the gift first. That goes in, and they put the gifts in chronological order before you put the estate that they left on death. And then literally you just go, right, the first 325,000 is taxed at naught. The next 175,000, if they qualify for the residence nil rate band, is also taxed at naught, and then anything above that is going to be at 36%. So as you can see, they might not pay any tax on the gift that they've made, but it forces the rest of their estate up, if you like, and could generate tax on the rest of their estate. Now, as I say, the residence nil rate band is available in certain circumstances, and it was introduced in April 2017. You can't use it for gifting, so it only comes in on death, and it's only available. So my slides seem to stop moving. There we go. And again, you can transfer it like you can the standard nil rate band, but it's only available where somebody passes on a property or an interest in a property to what's called a lineal descendant. So it's only available to people who own property and people who have children. I don't know, they did it this way. I don't know the rationale for doing it. As I say, they could have just increased the nil rate band. That may have reduced receipts a little bit, but would have been a lot less complicated. So the residence nil rate band, as I say, you must have a property. It must have been your home at some point. So it can't be a buy-to-let property or anything like that, but it can be a second home. There's no mention in the legislation about it being in the UK, so you can use foreign property as well. But it has to be a residence, it has to be a home. It doesn't have to be a main residence, but just a home. And it has to go to what we call lineal descendants. That's children, grandchildren, stepchildren, foster children, and so on, their spouses, and their widows and widowers, providing they don't remarry, and you can pass the money down and you get the extra £175,000 at 4%. So you'll save 40% of 175,000, which is good. It does taper, so if somebody's got an estate of over £2 million, then that £175,000 reduces. So for every £2 of over £2 million, it reduces by £1. So it tapers. So once you get to 2.35 million, it's basically gone now. That's sort of to stop the very wealthy from benefiting from it. But to confuse matters, the value of the estate that they use in this instance for the £2 million is different to the value of the estate that you use for inheritance tax, which is just very complicated and partly unnecessary. But literally the £2 million is just what people own when they die. That's it. So you don't have to worry about any money that they've gifted, but you don't get any reliefs on it. So things like business relief or agricultural relief and spouse exemptions don't apply because exemptions are relief. It's valued before that point. So a different way of calculating it that people have to be aware of, just to make sure. But because of the tapering, as I say, once they get to 2.35 million, then they don't get the residence nil rate band. And if you have a transferable nil rate band, so somebody's entitled to 2 lots of it, once it gets to 2.7 million, again, it tapers to 0. So quick look at making gifts, conscious of time, but yeah, so potentially exempt transfers, as I said earlier, if I make a gift to, say, my brother and just give him some cash or give him property or whatever asset that I want to give him, maybe I've got a rare painting hanging on the wall that I want to give to him, well, that's going to be a potentially exempt transfer. And that basically means that it's not included in my estate, providing I survive for 7 years. If I die within 7 years of making that gift, it comes back into the calculation. But I can make as many gifts as I like of any amount, and it's irrelevant unless I die. So you need to make sure that people who do these gifting do it. Obviously, if they're in poor health, then there are different issues because the likelihood of surviving 7 years could be depreciated. But important to make sure that they do, or at least they plan for it. And how it works, as I say, 7-year cycle. So somebody makes a potentially exempt gift, 2 years later they do another gift, another 2 years later, so 4 years later they do another gift, 6 years later they do so again, and then 8 years down the line they make another gift. Now they're still alive, so these gifts are all potentially exempt, and if they survive 7 years they become fully exempt. So the one that was made 8 years ago, that drops out of the equation. So the person can carry on making gifts as much as they like, providing they survive 7 years. And that's what you need to do, is just to make sure that people keep a record of what gifts they've made, because potentially there could be tax on it, or it's going to impact their tax when they die. So that's how most people gift money. They will just make outright gifts to family and friends. If they use a trust, then if it's a discretionary trust, it's what's called a chargeable lifetime transfer, and that works slightly differently in that when people start to make gifts, if they exceed their nil rate band in a 7-year period, well, they have tax to pay at outset, which is 20%, which is the lifetime rate. So if we have a look at how that works, there we go. So somebody makes a chargeable transfer, so puts money into a discretionary trust, and I'll explain why they might prefer to do that. And then 2 years later, make another chargeable lifetime transfer. Well, it's cumulative, so you add one to the other to see what they've paid in. Obviously, they haven't paid it. They've only paid money into Trust 1 and Trust 2, but you add them all together. And if they make a third one, then you add them together again. In this instance, we've got 150,000, 3 payments. So they've made a second payment, which means a total of 300,000. That's within their nil rate band, so the tax is 0. But when they make their third payment, that means that they've in total in 7-year period made £450,000, which means that they start paying inheritance tax while they're alive, albeit at 20%. And if they died within 7 years, they get a credit for the 20% that they paid, so they won't get taxed twice. But obviously, if they pay the 20% and then live for 7 years, they're not going to get a credit because it's not going to be included in their estate. So it's a bit of a gamble when people do it, but people still find it a better thing to do than leave it in their estate and pay 40%. And that's where control comes in, because that's why people want to use trusts. So we might have an instance here where you've got somebody who wants to give money to a beneficiary, which they can do, and they can give them cash and they can go and spend it. But as I said earlier, you might have instances where you might not know who all the beneficiaries are. You might sort of say, right, I'm going to give it to my grandchildren, but there might be others born in the future. So I don't know who they are. They might not be financially mature enough to handle a big sum of money. So what then happens, rather than giving money to the beneficiary, the person can set up a trust. Now, a trust is just a legal document whereby you have a trust deed which explains who the beneficiaries are, what the trust property is and what's in the trust, and who the trustees and the beneficiaries are. Sorry, yeah. So effectively, the person would appoint trustees to look after the money. So they would pass the money to the trustees, and then the trustees would, in the terms of the trust would give them the instructions of what they're legally bound to. They would then pass money to the beneficiaries as and when it is required or needed, or if there's discretion provided, if the trustees think money should go to a beneficiary. Now, the different types of trust you can use, a bare or absolute trust is a very rigid, inflexible one, but it is a potentially exempt transfer, so it has the ability of not being constrained by the nil rate band. So at outset, the trust deed will say, these are the beneficiaries and these are the percentages that they're entitled to of the trust fund, and they cannot change. They are set in stone. So very rigid, very inflexible. There's no discretion, but very useful if you need to want to give money to, say, minors, give them to children who are not old enough to take that money. And that's where you see them in wills. If you leave money to a minor in a will, basically, if you die and they're under the age of 18, you're creating a bare trust. Because the money goes into trust, and when they hit 18, they get the money. And that's just that's in law. That's in statutory. That's a statutory will, because the executors can't get proper discharge from the beneficiaries because they're under the age of 18. If you use a discretionary trust, which is whereby you can basically have a broad selection of potential beneficiaries, that's a chargeable lifetime transfer. And that's the reason for explaining the difference a few slides ago. Because people like discretionary trusts because you can put money into it, the trustees can hold it, and the trustees decide who benefits and when. And that gives a great deal of flexibility moving forward. So I could put money into trust for my children, and make my brother, for example, the trustee, and then he can decide when my children need it. So rather than when they're 18, they get a chunk of money, he could say, right, I'm going to give you some money when you're at university, I'll give you some money after that, maybe you can use it for house purchase, and I'll keep some money back for grandchildren or great grandchildren. So you can run these trusts anything up to 125 years. And it just means that people have discretion, and it gives control. So if I tell my brother what my objective was around this trust, he can then bear that in mind when he's making any decisions, but it's got the power, if he wants to make payments on an ad hoc basis if he thinks the circumstances have changed and warrant it. So a very, very powerful tool for controlling money past my death or the death of the individual who set it up. So very useful, and the ability to skip generations. If I were to die and leave everything to my son and daughter, I could be creating an inheritance tax problem for them. But if I leave it to a trust, it doesn't create an inheritance tax problem for them. They can benefit from it, but then it skips their generation, could go to their children. So very, very useful from that point of view. But because they're so flexible, they get taxed a lot differently and a lot higher than an absolute trust. Now, there's also things called agricultural and business relief. Just conscious of time, just check my watch. But agricultural and business relief were introduced a number of years ago. And it was mainly around people who had businesses. So if you had somebody who set up their own business or had a farm, for example, if they died and there was a large amount of inheritance tax to pay, what the government wanted to do is make sure that they didn't have to sell their business or sell the farm to fund the inheritance tax. So they devised these reliefs which are available. So if somebody has a farm, for example, and dies, providing it's been used for agricultural purposes prior to death, then there's a relief against inheritance tax. They don't pay any. Similarly with a business, if I set up a business and it runs quite happily and quite merrily, rather than my family have to sell that to pay the inheritance tax, they would get, or my estate would get, relief against that. Excellent objective to fulfill. It has changed over recent years. Especially business relief, we've seen sort of significant changes whereby it actually allows sort of AIM shares to be held. So anything on the alternative investment market can be held and potentially qualify for business relief. So not quite meeting the policy objective. I mean, it's if I had shares in Aston Villa Football Club and died, it's not going to affect I'm not going to have to sell Aston Villa. I'm going to have to sell the business to fund my inheritance tax liability. So not quite meeting the original objective, but it does encourage investment into alternative things, into like the alternative investment market, so on. So it does give an opportunity. And once people have had those types of assets for 2 years, they get relief either at 50% or 100%. So A very, very useful way of doing it. If you start going into alternative investments, if it was my own business, obviously it's a bit different, but if you start going into alternative investments, generally they carry a higher level of risk. So it's not a solution that you would use for an entire estate or an entire investment portfolio, because, as I say, generally they carry higher risk, and people are later in life. So if they're later in life, they spend their in 30, 40, 50, 60 years accumulating wealth. They don't really then want to take too much risk with that money later in life and potentially have it dwindling down rather than up in value. Although obviously you've got to factor in the tax, but very good for sort of parts of a portfolio in certain circumstances, or maybe where life expectancy isn't going to be 7 years. So useful if people can use it. Every once in a while, for some reason, HMRC do tell us how much it's actually cost HMRC to have these reliefs. And as you can see, we had some figures in 2015-16 where you can see it's around about 2.6 billion is what it is actually cost HMRC. And there has been some expectations about some changes, especially around the business relief and the use of AIM portfolios, as to whether anything will change around that. Nothing has happened yet. There's nothing to say that it will happen, but as I say, they make these press releases every once in a while and tell you how much it's costing, and provide you with some details about it without people asking. So it just makes you wonder if they're actually watching it. But we'll have to wait and see if anything does change in the future. And finally, almost just past 11, we'll look at life assurance is another solution, and it's a very simple solution and something that is often overlooked. And it's very straightforward. If I have an inheritance tax of, say, or I'm expecting an inheritance tax liability when I die, say for argument's sake it's a £200,000 inheritance tax bill, what I could do is I could take out a life assurance policy on my life to pay money to my beneficiaries when I die, and they can then use that to pay the inheritance tax liability. Very simple, very straightforward. I can fund it, and I can use the gifting out of gifting surplus income exemption if I want to, so it makes it a nice and clean. I have also heard of instances where, say I didn't want to fund it, my kids could fund it, because ultimately they're going to benefit from it, so why not make them pay for it? Some people have that attitude, it's fine. But yeah, so it's a very simple, straightforward way. It allows me to use my estate. I'm not making a gift. I'm not giving money away. I'm not having to take an unnecessary risk with it. So I get to use my estate as I want to up until the date I die. And then, as I say, there's just a life assurance policy, usually held in a discretionary trust, that just pays money out to the beneficiaries and they pay it. So very, very simple, usually very cost effective as well. It can be. It just depends on the cost of the life assurance, and that's going to depend on people's health and age at the time they do it. But can be very good, especially if people start early. So I put this slide together just to give you some of the potential solutions. I'm not going to talk through them because I can talk about this slide for hours. But there are various different things that people do. There are different types of trusts people can use. I haven't gone into each of those because each will have its own different advantage and disadvantage. Some will provide an income. So, for example, if you have a discounted gift trust, I could put money into the trust and I've gifted it, but I retain the right to an income from it. So it can be very valuable, especially if you want to supplement pensions, that sort of thing. You've got AIM shares on there, as I talked about the business relief. Flexible arrangement trust and gift and loan trust are different types, and they have different types of benefits. Pensions are very efficient, but you lose control after a while. So can be very good for inheritance tax planning. Forests and woodlands is always a good one. If you drive up the I know the A14 or the A11 or something like that, you'll see signs saying forests or woodlands for sale, and that's because they're exempt from inheritance tax, providing you're not milling the wood as a business. So that's why people buy them. They're exempt, and then generally, the beneficiaries will sell it when it forms part of a legacy. So there is a whole range of things that people can do. The one I haven't even touched on is family investment companies, and that's used by the what I would term the ultra high net worth, so people who have tens of millions of pounds. Obviously, gifting something like £325,000 isn't really going to make a great deal of difference to them. But what they would do is they have different solutions available to them just because they've got a different level of wealth, and that would involve things like setting up a company and having the company owning their wealth, and it works slightly different, but still very effective. And obviously people can just go and spend the money if they want to. Not ideal, because it doesn't pass on the wealth. Obviously people want to help their children, help their grandchildren, especially with things like educational fees or university fees. Try and give them a step up on the property ladder maybe. And there is going to be an awful lot of wealth. The baby boomer generation has a lot more wealth, or is expected to have a lot more wealth than generations that are around now, because they generally have better pensions. They've benefited from property prices and very sharp increases in property prices. So therefore that wealth will be passed on. So although you may have people who don't think they have an estate planning need, they will do when earlier generations die and pass that wealth on. So the use of trusts can help with that, because as I said, it can skip generations, and it just means that you don't have that knock-on effect. But it's not going to be right for everybody. So it's just everybody can do something a bit different. I did do a quick slide on the 6-step plan. So it's just people making sure that their wills are up to date and making sure they make full use of the exemptions and the reliefs that are available to them. And then they start looking at trusts and that sort of thing, and how they can make their estate much more efficient from an inheritance tax and a control point of view. Right, okay, well that's me. I've got the contact details, they'll be on there, but I'm quite happy to take any questions. Obviously we've got the poll questions, I believe. Do we, Claire?
Yeah, Michael, are you able to make the poll questions live, please?
Yeah, I'll launch them now.
We have a couple of questions for the journalists today, just to see what your thoughts are on IHT, sorry, tax in general. So we have the first question here. Do you think inheritance tax should be increased to help pay back the coronavirus deficit? So there below that, you can see 3 multiple choice options. So we'll leave this up for around 20 seconds or so, just to let you all have a go. And when we've had enough people reply, Michael will show us the results.
Yep, okay, I'm going to end it now. And I'm going to share the results.
Wow, there we go.
Excellent, it's interesting.
Your results there.
I mean, the thing is, it's a 40% now, so it makes you wonder how much scope they've got to increase it. But it's yeah, it's a very, very emotive subject, inheritance tax.
Should we do the next one?
Yep, shall we move to the next one?
Yeah.
So, do you think inheritance tax is currently well understood by the public? Which is an interesting one for you guys.
Okay, 5 more seconds. There we go.
There we go.
Even clearer.
Yes, fairly cut and dry, that one. Yeah.
Okay, and then I'll launch the next question now.
Which personal taxes do you think are in most need of reform?
Okay, I'll end it now.
Wow, that's interesting. Yeah, I think everybody was expecting capital gains tax to be changed in the budget, and it wasn't. So,
Yeah.
So the feeling's still there.
Interesting.
Right. So thanks for that, and thanks Neil for that really informative presentation. We crammed in a lot there. I think
Yeah.
that was fantastic.
Yeah. I did skip through bits, but obviously people, when they get the slides, if they get any questions, they can always ask.
Yeah, so we can have a quick Q&A session now, but just to let you know that obviously any questions that aren't answered during the session, Canada Life will follow up with you directly. So you'll be able to get in touch with Rebecca and Neil, and they'll take you through the questions. So now, Rebecca, I don't know if there's anything you want to kick off with.
Yeah, perfect. So obviously, please send any questions you have into the Q&A box at the bottom. But just to kick things off, Neil, I wonder, what do you think is the most important thing for people who might be concerned about inheritance tax to be aware of?
First thing is to go and get advice, to be honest with you. I think I've only sort of scratched the surface around inheritance tax, and I think that poll question shows that there's a lot of, not misunderstanding, but there's a lot of lack of awareness around inheritance tax. And even, I mean, I've had instances where people have, you know, made Christmas presents of large gifts to their children, and not appreciated what impact that has. So anything like that, it's always worth speaking to somebody, a professional who understands these things a bit more, because something so innocent can have a knock-on effect, and if you start using gifts and trusts and business relief, it can have a knock-on effect for decades. So it's important to get it right at outset.
Yeah, absolutely. Yeah. Thank you. And just another quick one. As you're aware, IHT has been frozen for quite a while now, the threshold.
Yeah.
Do you expect more people will now be caught out, thinking that maybe it doesn't apply to them?
Yeah, definitely. Yes, I mean, you've got the nil rate band of 325,000, obviously, because that's been frozen for so long. As I said when I was talking to you, you've got the fact that property prices have increased almost year on year without much of a dip. So more people are going to get caught, especially in London and the southeast, purely because of a property price, and not necessarily because of anything, not because they're saving money or anything like that. So yeah, but a man in the street is more likely to be hit by inheritance tax. And we did see the residence nil rate band come in, which was excellent because it gives people an extra amount that they can pass on. But it's limited. As I say, if you don't have children, you don't have property, you can't use it. So it just seems a bit unfair, to be honest with you. More people are going to get caught, and we can see that if you look at the red book at the budget, you can see the forecast for the tax just constantly going up. Even when they introduced the residence nil rate band, it was still going up. Nothing's going to change in that respect. But I think there was a report by the Office of Tax Simplification, which just basically said, look, you need to make these things easier to understand, and they started to some extent to do that. But making it easy to understand and making it a bit fairer is different, to be honest with you. So they just need to be careful, but more people will be caught, unfortunately. But if they plan for it, they can help reduce that. They can help reduce the impact of it. So plan early, really.
Yeah, planning is key. I can't see any more questions in the Q&A. I'm aware that we've kept you for possibly long enough now. Claire, do you have anything else you need to cover?
No, I think we will wind up there because we did overrun. Well, we did overrun. But thanks for everybody who was patient with us and stayed on and so on. And of course, thanks to Neil and Rebecca. That was fantastic and very informative. And you guys are, of course, available for journalists anytime. I'll be sending over everyone who attended copies of the slides from today and your contact information. So please do follow up with them if there's anything you want to clarify later on.
Okay.
Bye. Thanks again, everybody. Bye.
Yeah, thanks very much.